Be Wealthy and Smart, episode 1388.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the most volatile week we've had this year, what caused it, and where do we go from here. Last week marked the most volatile week of 2024 for the stock market. The Dow on Monday tumbled 1,000 points, while the S&P 500 lost 3% for its worst day since 2022. This was from a disappointing U.S. payrolls data number from the prior week and concerns that the Fed was too late with rate cuts, which may be causing a possible future recession. Along with that was the unwinding of the yen currency trade by hedge funds, who were borrowing in yen and investing using multiples of leverage into high-yielding investments. A change in the value of the yen caused losses, and the hedge funds had to unwind those trades very quickly. But the stock market recovered from Monday and had an incredible comeback from Monday's violent drop. In fact, the broad market index ended the week just shy of completely reversing its weekly losses. The S&P was up 0.47%, the Nasdaq ended up 0.51%, and the Dow ended up 0.13%. There was some encouraging data that came out on Thursday with the weekly jobless claims number, which helped alleviate investors' concerns about the economy. And that helped the market rebound from Monday's lows, where the S&P was down nearly 10% from its recent all-time high. The CBO Volatility Index, or the VIX, which is used by Wall Street to measure fear, reached heights that has only been seen since the onset of the pandemic and the Great Financial Crisis. The bond market also fluctuated wildly, and the 10-year Treasury yield fell below 3.7% at one point, only to retake 4% on Thursday and end around 3.94% on Friday. We can get volatile trading activity during the summer because a lot of traders do leave for the summer, and there's generally not as much information flow, and earnings season starts to wind down, so it's not uncommon to have more volatility in August. According to Jay Hatfield of Infrastructure Capital Advisors, he said, "A volatile sell-off and bounce back is just normal August and September behavior. Thin markets, hedge funds gone wild, and irrational moves down. The recent market activity has no bearing on our long-term outlook." Well, I disagree a little bit. I see short-term volatility and weakness through the end of August, so I think we have to be a little bit cautious here. We can continue to see this volatility for these very reasons. We also have the threat of a potential war in the Middle East, which sent crude oil prices up 4% for the week. The U.S. is said to be working through diplomatic channels to avert an escalation of hostilities, and we'll have to see how that all plays out. All eyes are typically on NVIDIA, which had a 2% weekly loss and is down more than 10% since the start of August. So far, more than 91% of companies in the S&P 500 have posted their quarterly financial results, according to FactSet data as of Friday afternoon, and of those that have reported, more than 78% of companies have beaten Wall Street's expectations. So earnings are looking strong for many companies. Sometimes that can be a misnomer because we know we have 7 companies in particular that control a lot of the performance of the S&P 500. So it's important that the earnings are good at those mega cap companies. This week, Home Depot, Walmart, and Cisco Systems will be reporting earnings. Besides energy outperforming for the week, industrials and financials were the only other sectors in the green for the week, with gains of 1% and 0.5%. Traders at Goldman Sachs expect the stock market to continue regaining ground from this week's sell-off, but not in linear fashion. From here, choppy but higher, they said in a note. The tremors we are feeling won't disappear tomorrow, but we don't get the sense anything sinister is brewing where it clearly was in November of 2008 and in March of 2020. They also added that buying 5% dips in the S&P 500 has proven to be a very sound strategy over time. And I would agree with that. I think we will get that drop this month, so I'm thinking more toward the end of the month would be a good time to buy. But I don't see this as the beginning of a crash, and that's an important distinction. We have normal corrections where markets pull back, and especially after such a strong first 6 months of the year, it's not unexpected to have the market consolidate those gains for a period of time. So I think August could be sideways to lower, but we may see more volatility in some of those leading mega cap stocks who have really had big gains this year. And that may give you an opportunity to buy them on the dip lower. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.